Hey, what's up, my friend? So, in today's training, it's all about swing trading, baby. So, you will learn, right? Swing trading secrets, right? Profitable trading strategies and techniques to profit in bull and bear markets. So, specifically, right, here's what you'll learn in today's training. Number one, we'll talk about what is swing trading and how does it work. Number two, what are the best market conditions for swing trading to, have the maximum profit potential. Number three, I'll share with you two powerful entry techniques, right, to time your entry into a swing trade. Number four, we'll talk about how to exit your swing trades for consistent profits, right? In essence, right, how to exit your trades before the market reverse against you and erode all your open profits. So that's what we'll be discussing. And finally, the best time to enter a swing trade that nobody tells you. So with that said, let's get started. Number one, what is swing trading? So in essence, right, swing trading is about capturing just one move in the markets. So what is one move? So it's useful, right, to kind of just illustrate to you what I mean, right? So let's say the market is in a range, okay, and it swings up, swings down, swings up, swings down. So as a swing trader, what you're trying to do is to, for this case, right, buy the lows of the range and sell at the highs of the range. So in essence, you're just trying to capture this one swing over here. You can see that this over here is one swing. Alternatively, right, the market could be trending and you can also capture swings in an uptrend. For example, market is trending, you can look to buy the dips and sell the rally, right? So you're in essence, right, trading or rather capturing this one swing over here. So hopefully this gives you a good idea to what swing trading is about. And by the way, if this is the first time you're watching my video or you just love what I do me a favor, hit the thumbs up button and subscribe to my YouTube channel. This way, right, it helps with the YouTube algorithm, right, and more people can benefit from this training, right? So do it right now. And moving on, best market conditions for swing trading. So in my opinion, right, swing trading, right, it's great to do to trade it, right, when the market is in a range or a wick trend. So this is something that you should be familiar with since I pretty much just drew them earlier. But I want to talk about wick trend. So what is a wick trend? So a market is in an uptrend where you have a series of higher highs and higher lows. Okay. So for a wick trend, this is when the trend, right, the pullback is deeper than usual, right? If you use Fibonacci retracement, for example, you realize that the retracement usually retrace to a minimum of at least a 61% retracement, 618 retracement. That's a kind of like the bare minimum for a wick trend. And if you kind of overlay with a 200 period moving average, right, the price, right, has a tendency to retest the 200 period moving average as well. I'll share that later on. And for a range, it's quite straightforward. Range is just simply like this, right, where you can identify the highs. Oh, this is bad. Where you can identify the highs and the lows, right? The highs and the lows, then range is just, up and down, etc. So let me walk you through a few examples. So first one over here, you can see that over here, this is the chart of Aussie dollar, and you just zoom out a little bit. You can see that this market is in essence, right, a trend, a downtrend, and it's a weak one. Notice the pullback, right? I want you to pay attention to the pullback. It's pretty deep, right? From this lows all the way up to this highs, this lows to this highs, this lows to this highs, and this lows to this highs. And as I was saying, right, if you were to pull out a Fib tool, right, for those of you who are familiar with Fibonacci retracement, I'm just going to get this one out. Where is it? Fibonacci retracement. And I just pull it from swing high to swing low, right? You'll see what I mean. So in this case, let's say we go with this highs to this lows over here. And you can see that this market, this particular swing, right, swing from this highs, okay, to this lows. Okay, and this retracement, right, hit up to about 618 retracement at this point. Okay, so you can see that when the market retraces, right, in a weak trend, the retracement is usually pretty deep. Okay, so you can just pull this down. Let's do another one example. Let's say we take into consideration for this move over here, right? Just again pull up from the highs all the way down to the lows. Okay, and in this case, the retracement is even more than 61% retracement, right? In fact, this move, right, almost approaching the 786. So this is one way, right, to find out whether the market is in a weak trend or not. Okay, so that's one. Alternatively, for those of you who are familiar with moving average, you just pull out your 200 period moving average. You'll notice that the price has a tendency to retest the 200 period moving average as well. So there's a couple of tips to share with you on how to identify a weak trend, but this isn't the main point of today's training. Okay, so now that you know the best market conditions to trade for swing trading, let's talk about how do you actually time your entries, right? How do you time your entries for a swing trade? So there are a couple of entry techniques that you can use. Number one is what I call the false break technique. Okay, let me share with you what I mean, right? So for example, let's look at the crude oil. You can see over here, if you look at the charts, right? Notice this move over here, the price came down all the way into this lows over here. Okay, this is a significant level because if you look left, right, market tested once, twice, right, and once, twice, 3 times, right, and back here a 4th time, and it took out the lows of support, right? So this is the lows of support. This move actually took out just by a few ticks, and then it rallied higher, right? It closes higher, and this candle has break and close above the previous day high. So this is what I call a false break setup, where the market has a false breakdown. This one over here, another example, market trade up to the highs over here, taking up the highs of this area and this area over here. Then the next candle have a sudden reversal lower, closing near the lows of the range. This is another false break of the highs. Okay, so this is what I mean by a false break. And let's see if I can find one more example to kind of nail home the point. Another one is this over here, Aussie Canadian. The market again, you see over here, right? Price comes down all the way down into these lows, and then the next candle, it staged a pretty strong rally up higher. Another false break. Okay, so this is an entry technique that you can use in swing trading, false break, and later on I'll explain to you step by step, right, how to actually time your entries, exits, and much more. But for now, I just want to share with you this entry technique, right, called the false break setup. So the other technique that you can also use is what I call a break of structure, and it's on the lower time frame. So let me share that with you. So for this one over here, right, for example, you look at the chart of platinum. Okay, so at this point you can see that this market, it's at an area of support, right? Price broke above this highs, breakout, okay, and then retest back this breakout level. So now it's at previous resistance turn support. And earlier we mentioned we talked about the false break setup, but also, right, besides the false break, you can also look for a break of structure. So if you look at this move over here, okay, this kind of look like an ABC pattern, right? The ABC pattern or ABCD pattern, right? ABCD pattern, right? On the lower time frame, you will see that the charts, right, will look something like a downtrend with a series of lower lows and lower highs. So let me just share it with you. So as you see over here, this entire move, right, this is actually the ABCD pattern that you saw earlier on the daily time frame. So when we talk about the break of structure, what we are looking for is for the market, right, to invalidate this existing market structure. So this existing market structure is, in essence, right, a series of lower highs and lower lows. So what we are looking for is a series of higher high and higher lows, telling you that the buyers, right, are coming in and ready to take the price out higher. So at this point, you can see that over here, this is the resistance. You have a series of higher lows, and over here you have a higher high. Right, this tells you that now there is a break of structure. It has invalidated this series of lower highs and lower lows, right, by forming a new break of structure where you have a higher lows and higher high at this point. Okay, so this is another entry technique that you can use, right, of and I call this the break of structure. So let's see if I can have another example for you. Okay, one more example, Aussie Canadian. Let's look at the daily time frame. Okay, you see over here, again here, price is at this area of resistance here. Okay, so on this time frame, it's difficult to identify the break of structure, but if you go down again to the 4-hour time frame, you'll see what I mean. So at this point, again, you can see over here, what is a break of structure? So previous market structure, right, you have now a series of higher lows and higher highs. So a break of structure is where you're looking for the market to make a lower low and lower high. So at this point, market, when it broke below this lows, right, now you have a lower high and a lower low. So there is a invalidation of the previous market structure, which is, this portion of this move over here, right? So at this point, when the market break below this low, you now have a lower low and a lower high. And this is what I call a break of structure. The break of the previous structure of the markets, right? To signal that the market, right, could possibly reverse down lower. Okay, so of course, we don't trade these entry techniques in isolation, right? We will combine this with a number of factors, right, to identify, swing trading opportunities. But I will get to that point later. But still, right, we need to, go through step by step, right? So at the end of this training, when I piece all the puzzles together, you kind of like, that is what Rayner is talking about. So I will get to that point, right? But you have to, stay with me on this, right? Don't run away. So next one. How do you exit your trades as a swing trader? So if you recall, right, swing trading is all about capturing one swing in the markets. And logically, right, when you exit your trades, you want to exit your trade before opposing pressure comes in. So as a swing trader, you're not trying to ride trends in the market. So for example, let's say, market is trending higher. As a trend follower, you try to, capture this trend, right, till it ends. So you try to ride this entire move in the market. They will, endure the retracement, endure the pullback that comes along the way. But for swing trader, we are not interested in that. We are just interested in capturing that one move in the market. And that one move in the market, the way we do it is that we want to exit our trade before opposing pressure step in. So for example, a simplified one, you buy the lows of support, right? Where do you want to sell? Ask yourself, where will opposing pressure comes in? And if you look at this, right, clearly, right, opposing pressure will likely come in at resistance, right? Where people are looking to sell at resistance and take profits at that level. So this is where opposing pressure will step in. Alternatively, right, if we talk about a weak trend, okay, with a deep pullback, comes in, it makes a deep pullback, you buy near the lows of this pullback, where do you want to sell? Where will opposing pressure come in? Well, likely they will come in near this highs over here. So you want to be selling, right, just before the highs at this swing high over here. So this is what I mean by identifying levels where opposing pressure will come in. And this is important. So I want to walk you through a few simple, exercises to kind of, train your eyes for this. So let's see. If you look at this chart, this is Euro Aussie daily time frame. Let's imagine that you are right now short this market. You just sold off at this lows. I want to ask you, where is a logical place to look to take profits? Where is a level or area on your chart where opposing pressure would come in, right? Look at this chart. Ask yourself. Okay, give you a few seconds. 1, 2, 3, 4, 5. So if you ask me, right, this is a level that you want to be paying attention to, right? And possibly, right, look to take profits, right, at this, as this is where you will find potential buying pressure coming in, right? Notice here. Let me just zoom in a little bit to see. Okay, so if you just zoom out, okay, notice that the market has respected this level a number of times. Once, twice, right? This is a breakthrough. 3, 4, and 5. So you can see that clearly, right? The 1.6 area, it's a significant level. And if you're short this market, right? Just imagine that you are short, right? You have a valid setup and you're short. This is an area that you want to be taking profits to just capture this one swing in the market, just that one swing lower. Bum. Okay, you're not trying to ride this entire move down. That's trend following, not swing trading. Another example, right? Pound against the Swiss franc. So imagine, right, you look at this chart right now. Let's say you are long and you're trying to capture one swing. At which point on the chart, right, will you want to exit your trade for that one swing? Let me just zoom out a little bit so you can kind of see the big picture. Are you done? Okay, so if you ask me again, I would say this area over here, this area is a potential area to take profits, right? So you can see that if you just zoom out a little bit, tested a number of times. In fact, I'll just pull it down even lower, possibly somewhere here. Okay, so tested once, twice, 3. This is a false break, but still I'll consider it a test, right? Since it went back below the area. 4 and 5. So if the price, right, were to come to around the 132, 131 area about here, this is where you want to consider taking, your profits to just capture this one swing over here. Okay, moving on. Aussie, New Zealand. Let's look at a different time frame, right? Weekly time frame. Let's say you are long, right, for whatever reason, and you want to capture one swing in this market. Where will you exit the trade? Look at this chart. Right, let me just zoom out a little bit in case you want more details. 1, 2, 3, 4, 5. All right, so to me, right, I would say this area is an area where you want to exit your trade around this area, right? I would say around here. Okay, because this over here, you know, is where it's a swing high, right? Selling pressure could be present, right, to, you know, push the price down lower. So this around here between the 107 to 108, this is a potential targets to capture one swing. On the other hand, let's say you are short this market. Where would you exit your short trade? Where? Okay, if you ask me again, my opinion, right, I would say here is where you want to consider taking your profits, right, to capture that one swing, because this is where the price, right, tested once, twice, 3 times, 4 times, almost 5 times, right, and there's a good chance, right, you know, buying pressure could be lurking there to take the price up higher. So that is a good area to be taking profits off the table, right? So this is how you exit your trade for swing trading. In essence, you're just asking yourself, where will opposing pressure comes in, and you want to exit your trade, right, before opposing pressure comes in. And one thing to share with you is that you don't want to get greedy, right, in setting profit targets. You know, I know what some traders will do is that they will set their targets, right, at the absolute lows over here, trying to squeeze the market out of every pips, and that's not a good idea. Why is that, right? Because remember, you're dealing with areas on your chart. The market may not get to these lows and reverse from there. It might just come to this here and then reverse. And if you have your target, right, at this type of, you know, greedy levels, you will not, you know, exit with the winner, but the loser as the market, you know, reverse and hit your stop loss. So again, right, don't be greedy with your targets, right? Give the market some buffer, you know, give it some room, right, to take you out of the trade, right? Don't aim for the absolute highs or lows. So that's how you exit your trade. So now, I'm going to share with you something interesting. So when is the best time to enter a trade? Okay, so what we've discussed so far is, you know, the best market conditions to enter, entry techniques, and exit. So when is the best time to enter a trade? Okay, so let's have a look. So looking at this chart, euro dollar. Okay, get this out of the way. And if you look at this, right now this market is in a weak trend. Okay, and walk me through on this, right? Just walk me through. Let's say you're looking to short this market in a downtrend and looking to capture that one swing. Your entry point, let's say you use a market order over here. Okay, and where do you set your stop loss? Would you want to set your stop loss, right, at this highs of resistance? In essence, this level over here. Do you want to set your stop loss at that level? Not quite, right? Because you know that this is an area of resistance, and also if you pull out your 200 MA, you know that the market, you know, is finding resistance, right, at the 200 period moving average as well. So this is an area of resistance, and it doesn't quite make sense to be setting your stop loss at this area of resistance, because the market could come up higher, hit your stop loss, which is at resistance, and then collapse lower. So this clearly isn't a good idea to set your stop loss. So to set a proper stop loss, right, you want to set it at a level, right, where if the price reaches it, it will invalidate your trading setup. So this means, right, you want to ask yourself, right, at what price point level, right, if the market hits that level, this resistance will be broken. What price point level? So one technique I can share with you is you can use the ATR indicator and just add on one ATR towards the highs of resistance. So I usually use 20 period ATR and I go with SMA. And what you want to do is find out what's the current ATR value, and the current ATR value is about 40 pips right now. So what you want to do is that since the highs of this resistance is about 1.118, let's make it 1.118, right? What you want to do is add on 40 pips to it, right? So your stop loss, right, it's over here, stop loss 1.118 plus 40, so that should give you 1.122. 118. No, 122. Yeah, 122. Okay. And you press OK. And there you have it. Okay, so now your stop loss is at this price level. And how you get this price level is that you take the highs over here and add on 40 pips. And this 40 pips is based on the market's volatility over the last 20 days. That's 20 period ATR. Next question is, where do you want to exit your trade? Well, as you know, right, swing trading, you want to exit your trade where, before, you know, the opposing pressure comes in. And if you look at this chart, this lows, right, I think you can agree that, you know, this is where potential opposing potential buying pressure could come in, right? Tested once and twice. So you will then, shift your targets to possibly somewhere about here. And if you look at this potential trading setup as of right now, what you're in essence doing, right? It's let me just bring this towards the left so you can see. Okay. That your risk to reward, right? You're risking $1 to make 34 cents. How do I know that, right? Well, you can see that, right? This is your risk, and this is your potential reward from here to here. And if you look at this tool, right, it tells you 0.34. And if you ask me, not a trade that I want to be taking. I don't want to be risking $1 to make potentially, 34 cents on the trade. Okay, so what should we do? Well, this is where patience play, right? This is where you want to let the market come to you. So let me just do one simple tweak. So let's say instead of chasing the markets lower, right, we trade it from a favorable trade location. Okay, we let the market come to you, right? So we will be camping, we will be waiting at this area of resistance instead. So now let's say our entry price is, let's say we shift it up higher to somewhere about here. Again, our stop loss is the same level, right? Let me just shift it down to 122 level, which is here. And our targets, again, is the same price level around here, around this swing low over here. So now you can see that by being patient, right, we have dramatically, right, turned the table. Now we have a potential risk to reward of 2.22. This means that you're risking $1 to potentially make $2.22. See the difference? By trading from an area of value, right, you have, put yourself, right, in a more favorable risk to reward trade. And this is powerful stuff. It doesn't matter whether you're a swing trader or a day trader. This concept can be applied the same, right? Basically measuring, right, your potential risk on the trade to your potential reward, right? And the best time, right, to be timing your entries, right, is where you're near the area of value, because that's where your stops, right, can just go, beyond it slightly. So let me share with you one more example. How about this one here? Let me just get rid of this tool first. New Zealand dollar. Okay, same concept, right? We're going to go through the same concept. So let's say at this point, right, you ask yourself again, right? Let's say we are going to buy at market. Let's go with market at this price point, right? Long position, let's say it's over here. Okay, where do we set a stop loss, right? So you know that, again, you don't want to be putting your stop loss, right, smack at this level, because the price will come down, then encounter previous resistance, turn support, and then reverse up higher. So you want to set your stop loss, right, away from the area of value, right? And you know that this is over here is the area of value, and to set it away from it, you want to set it somewhere lower, let's say somewhere about here. Okay, you can use the ATR indicator tool again. This case about 40 pips, right? Just take this lows of previous resistance turn support, you minus 40 pips, right? And let's say it's at this price point over here. Okay. Next thing, targets. Where do you want to exit your trade? Because as a swing trader, you want to exit your trade before opposing pressure comes in. And if you look left, okay, you realize that this is an area of resistance, right? Market tested once, right, twice, then over here 3, 4, 5, and this false break over here. So it's a significant level. So as for targets, right, I would say this over here around the 6698 level, right? It's a decent place for taking profits. So if you look at this from a risk to reward standpoint, again, here is 0.86. So risking $1 to make 86 cents. So again, not the best in terms of risk to reward. So again, how do you improve things? Again, remember I said, right, let the market come to you. You want to be trading as close as possible towards at the area of value. So where is the area of value? You know that this over here, previous resistance turn support, this is the area of value. So now let's adjust things again, right? Let's say our entry point, we get it at a much better level. Let's say just above this area of value, right? A stop loss again at the same price point, about here. Okay, and this time around, our target, again, at the same price point about here. So by being patient, right, you can see that now your risk to reward has changed, right? Now it's about 3.18, risking $1 to make $3.18. Again, your target is the same, your stop loss level is the same. The only difference is at the price point you are entering. Does it make sense? Okay, and if you ask me, right, these are the best times, right, to be entering swing trades, right? Because your risk, right, is lower. Your stop loss is tighter as you're just setting your stops just beyond market structure, just, one ATR away from it. And your targets is the same, right? And that's how you get, favorable risk to reward trades for yourself. Okay, so this is, this is powerful stuff, right? Don't neglect this. And before we end, right, let me just walk you through a few examples, right, of swing trading opportunities that you can identify for yourself. Okay, so Aussie dollar, that's one. This is one, right? So what I'll do is that, again, right now the price, I know that this is an area of value over here, right? Resistance area, and as well as the confluence of the 200 period moving average. And as you know by now, you don't want to be selling at this point. Okay, you want to let the market come to you. So what I'll do is that I would rather be waiting or camping at this area of resistance. My stop loss could go somewhere about here. And as for targets, right, I would say this swing low, it's a possible target to look to exit my trade. So from a risk to reward standpoint, let me just get out that tool again. Okay. Over here, let's say you sell somewhere about here. Stop loss is somewhere here, right? Okay. And your target is somewhere about here. So in this case, again, you're risking $1 to make $1.66. Not too bad. Let's go with one more example, shall we, before we conclude today's trading. And finally, platinum, right? So this is a trade that I took. Okay, so again here, at this point, price has retested this area, right? Previous resistance turn support. In this case, we don't have a false break set up, right? In fact, what we have is a break of structure, as you've seen earlier on the lower time frame. So over here, we had a break of structure. Okay, same thing, right? I had my stops, right? 1 ATR below this lows. As for targets, I was looking at this highs over here. So I think the risk to reward on this trade was about, I think, close to a 1-to-1. Okay, so you just see, in this case, let me just do that tool, use out that tool again. I keep pressing the wrong one. So it's about here, right? Your risk is this much, and your target is somewhere about here. So if you look at it from a risk to reward standpoint, right, it's about 1 to risking $1 to make $1, close to $1.20, right? So this is swing trading. You're just essentially capturing, as you can see over here on the chart. Let me just remove this. You're just capturing this one swing up higher, this one swing. Okay, and oh yeah, just one last thing, right, before I go, bonus thing, right, is how do you manage your trades? So let's say, for example, there are a couple of ways you can, do to manage your trades. So in this case, what you can do is that, let's say you have your entry, stops, and target, right? Your entry, stops, and target. Let's say entry is here, stops is here, and target is here. This couple of methods, right? Number one is what traders are familiar with, what we call a set and forget. You set your entry, your stops, and target. You let the market do what it needs to do. But the downside of having a set and target approach is that sometimes the market could reverse, right? And if you have a set and target approach, right, it's all or nothing. Either hit your target or hit your stop loss. And sometimes if you are more active, you have more time to watch the markets, you don't want to see your open profits, right, just get eroded like that. So one way you can go about it is that you can use a active trade management approach. So yes, you have your entry, stops, and target, but at the same time, right, you are in a way protecting your open profits, right, if the market moves in your favor. So for example, let me give you an example. So let's say Aussie dollar, okay? So in this case, let's say, you are looking for a target at this lows, for example, at this lows, okay? And you can see that right now the market is showing signs of reversal. But how much room should you give the trade to breathe, right? Because what if the price, could reverse up higher and then, break out and you get stopped out? So is there a protective mechanism that you can use for your swing trading to kind of protect your open profits? So one useful technique I find is that what you can do is you can trail your stop loss, right, using the higher time frame highs and lows. So for in this case, right, let's say assuming you short on the daily time frame, you can go up to the weekly time frame, right, and exit your trade only if the price breaks and close above the previous week high. So in this case, you can see that in this candle, right, it has break and close above the previous week high, and this is where you can manually exit the trade. So at this point, right, you have sort of protected your downside, to say, right, as the market hits your trailing stop loss. So the reason why you go up one time frame higher is to give it more breathing room, right? You can do it on the same time frame as your entry, but you realize that if you do that, right, more often than not, you will get out of the trade, prematurely before even the price can hit your target. So what I like to do is, to set it one time frame higher, trail it one time frame higher, and to see, right, if the market hits the higher time frame trailing stop loss first or the target that you have set for yourself. So this is another approach, right, besides the set and forget approach to consider when you are swing trading. All right. So with that said, quick recap. Range and weak trend markets, they are ideal for swing trading, but they are not the only type of market conditions for swing trading. You can also swing trade in a healthy trend. Entry techniques, I find that the false break setup and the break of structure are useful techniques to time your entry. You want to exit your trades before opposing pressure steps in, right? Remember, swing trading is all about, capturing one swing in the market, and you want to exit, right, before the opposing force comes in. And finally, right, your risk to reward is improved, right, when you enter near market structure. The further your entry away from market structure, the poorer your risk to reward. All right. So with that said, if you want to learn more about swing trading, price action techniques, what you can do is, again, go down to my website, tradingwithrayner.com. Over here, the link, all right, and just download this guide, the ultimate guide to price action trading. Click this orange button and I'll send it to your email address for free, right? This way you'll learn more about, price action, candlestick patterns, support, resistance, all this stuff, right, that complements swing trading. So go do it right now. And if you've enjoyed this video, hit the thumbs up button, subscribe to my YouTube channel, the link is below. Click subscribe, and I will talk to you soon.